Assalamualaikum warahmatullahi wabarakatuh to our lecturer, Madam Nur Azlina, and all beloved students. Today, our group will present about the roles of investment bank in capital market. My name is Farah Yuni binti Ismail, 19BB03001, and two others member of my group, one Muhammad Luhman bin Muhammad Kahiri, and also Muhammad Daniel bin Rozaimi. Okay, table of content of our group presentation is first is introduction, second the rules of investment bank in capital market, the third is distinction between commercial and investment bank, and fourth is function of investment bank, and the last is conclusion. Okay, we go to the next slide, which is introduction. Okay, the definition of investment bank. Let me introduce about investment bank first. An investment bank is a financial intermediary that specializes primarily in selling securities and underwriting the issuance of new equity shares to raise capital funds. Okay, this is different from a commercial bank, which specializes in deposit and commercial loans. Investment bank mediate between companies that issue securities and the individuals or entities wishing to purchase them. Okay, in this respect, investment banks operate along two main lines, a buy side and a sell side. Buy side operations include services such as securities trading and portfolio management. Okay, sell side activities include underwriting new line of stock, marketing financial products, and publishing financial research. Okay, now we move to the background of investment bank. Investment banks in Malaysia are regulated by the Securities Commission Malaysia. Securities Commission Malaysia, or we call that SCM, is a statutory body established under the Securities Commission Act 1993. It is also the main authority for capital market activities in Malaysia. There are 15 investment banks in Malaysia. As you can see in this slide, I attach the picture of 15 investment bank which I told you earlier. And then there are 100 largest bank from around the world.
Assalamualaikum, my name is Muhammad Daniel bin Rozaimi. My matrix number is 19BB03016. I will continue to present about the roles of investment bank in capital market. In general, there are four types of roles of investment bank in capital market, which is advisors, agency, underwriters, and market maker. Firstly is roles of an advisors. One of the goals of the investment banks is to help the business and governments by giving the advices on how to meet their financial challenges. This is because making the decision on how to raise capital is a major decision for any company or government. So they should ask for advices from the investment bank before making any big decisions. The banks will recommend the best way to raise funds for the businesses and government. For example, they can ask for advices before selling a portion of the company's stock or borrowing money from the public through a bond offering. In the case of a stock offering, financial experts will consider a number of criteria, including earnings potential and the management team's strength to determine how much a share of the firm is worth. If the client is providing bonds, the bank will compare current interest rates for similarly rated companies to determine how much compensation it will have to pay borrowers. Investment banks can also help in mergers and acquisitions. If a firm wants to buy a competitor, the bank can advise the company's management team on how much the company is worth and how to structure the acquisition in a way that benefits the buyer. They are more like facilitators than consultants. Mergers and acquisition is the word used to describe an investment bank's advisory group. Mergers and acquisitions stand for M&A, and it relates to the buying, selling, dividing, and combining of various businesses. If a firm wishes to sell an unproductive segment, for example, it will contact an investment bank to find a buyer. Mergers and acquisition agreements are facilitated in large part by investment banks. The advising group is responsibility of assisting buyers in finding sellers and vice versa, as well as facilitating the transaction. When a corporation hires an advisory group to help them market themselves to another company, they create a pitch book. The pitch book provides all of the pertinent financial data regarding the company that is trying to be acquired. The investment bank then presents the pitch book to companies it believes are interested in purchasing their client. Next is roles as an agency. Be an agent to the companies, which is matching them to the investors. Maksudnya investment bank ni akan menjadi agent kepada company dengan membantu mendapatkan investor. Tetapi servis yang ditawarkan tu akan dikenakan bayaran lah. Antara servis yang mereka buat adalah dengan membantu membuat merger or acquisitions, ataupun membantu issuing an IPO, iaitu Initial Public Offering of Shares. Investment bank ni bukan hanya terhad deal dengan syarikat yang trade secara public, tetapi syarikat yang trade secara private pun boleh deal dengan investment bank ni. An investment bank could be hired by a private company to assist with a merger or acquisition for issuing an IPO, Initial Public Offering of Shares. An investment bank could also be hired as a placement agency by a private company. Investment bankers play an important role in mergers and acquisitions. One of the primary areas of competence for an investment bank, similar to IPOs, is the capacity to assess the value of a potential acquisitions and arrive at a fair price. An investment bank can also assist in structuring and facilitating the acquisition to ensure a smooth transaction. Many small and private companies hire an investment bank as their agency. This is because they cannot access traditional financing markets for capital, and they need to either take on debt or find other sources of financing. In this case, investment bank can help them find those other sources of capital. Assume a company refuses to be acquired and is unable to obtain adequate financing from banks. They still need to raise money, but they cannot do so through public markets like the stock exchange, so they have to find different ways to raise capital. Private enterprise can obtain capital from variety of sources. The main capital sources are equity financing, mezzanine financing, and specialist financing, such as government loans. The majority of the time, placement agents are paid through fee agreements based on the amount of the money obtained and supported by the fund or firm they represent. Roles as an underwriters. An investment bank underwriters also help securities issuer like companies, businesses, and government lessen their risk in exchange for a premium. This is because the security issuer want to mitigate or lower the risk of having the unsuccessful issue. The underwriters will buy the securities from the issuer and then sell it on the market. The goal of the underwriter is to purchase securities at a lower price than the market and then sell them for a profit. Underwriters work with both businesses and government agencies. This issuer could issue stocks, bonds, or any other type of security. The investors can put their money to the institution that buying the securities. Underwriters are well recognized in investment banking for their participation in initial public offering (IPOs). When a firm decides to sell equity for the first time on the stock market, it is known as an initial public offering (IPO). They sell their own shares on the open market in order to raise funds by selling equity. On the other hand, investment banks are involved in the underwriting of a wide range of securities, not simply stock. The corporation must decide on a stock price that is both high enough to raise as much money as feasible and low enough to allow them to sell their stock. As a result, the offering of securities carries a risk for the corporation. This is a risk that the issuers of all types of the securities, whether sold by firms or the government, will be unable to complete a successful securities offering. This is where the securities underwriter's role comes in. In exchange for a premium, the underwriter promises to take on some of the risk of the offering. This will be a benefit to the issuers because it no longer has the risk of having to find enough buyers to purchase the securities at a desirable price. Investment banks also have a role as market maker. There are companies that are market makers, such as the investment banks that are familiar with. A market maker is a person who guarantees that there is enough liquidity in the market. A market maker also is a firm or individual who actively goes to side markets in a security, providing bids and offers known as us, along with the market such of each. A simple procedure of matching buyers and sellers determines the price of a stock. Those who want to sell the stock state the price that they are willing to sell a certain number of shares for the ask price. Those interested in purchasing must state the highest price that they are willing to pay for a specific number of shares. The bid-ask spread is a difference between the highest bid and the lowest ask price. If a person offer matches the other's ask price, they have established a price at which they have both prepared to conduct business, and the transaction takes place. In major stock exchange such as New York Stock Exchange, there are enough people who want to buy or sell at any given time. Then it's generally easy to find someone to transact with if you are making a bid or ask near the last price. This is called liquidity. The market also can be non-liquidity. This is because there are not many people interested in trading the stock. The highest bid price could be much lower than the lowest ask price, resulting in no transactions. Investors suffer greatly from a lack of liquidity. They will choose not to engage with the stock if they do not believe they will be able to buy or sell it when they need to. So it is important to have market maker like the investment bank that quotes both an ask price and a bid. This is because it can help to provide liquidity to the market and making the market more efficient.
Hai, Assalamualaikum warahmatullahi wabarakatuh. My name is Wan Muhammad Uthman bin Muhammad Bakari. My country number is 90BB03013. Today I will talk about a little bit the differences or this distinction between the commercial bank and investment banking. Commercial bank, first point is commercial bank is act as a manager for deposit account belonging to the businesses and individual or through they are primarily focused business accounts and they are make public loans from the deposit money that they hold. Meanwhile, investment bank, they are expedite the purchase, sales of bonds, stocks, and other investment, and aid the companies in making initial public offerings or IPO when they first go public and sell the share. Point number two, commercial banks make loans to people and small businesses and offer checking and saving accounts and certificate of deposit. Meanwhile, investment bank underwrite new debt, equity securities, help with selling securities, and drive mergers and acquisition, reorganizations, and broker trades. Point number three, commercial banks are highly regulated by federal authorities such as the Federal Reserve and the Federal Deposit Insurance Corporation or FDIC. Meanwhile, investment bank differ because they are much more loosely regulated by Security and Exchange Commission or SEC. Commercial banks are insured by federal government to maintain the protection for the customer account and provide a certain level of security. Meanwhile, on investment banks, the commission offer the less protection to customer and allows the investment bank a significant amount of operational freedom. Next, I will tell you why the commercial banks and investment banking are separated. It is because the Banking Act of 1933, the Glass-Steagall Act. The Glass-Steagall Act effectively separated the commercial bank from the investment banking and created Federal Deposit Insurance Corporation, among the other things. It was one of the most widely debated legislative initiative before being signed into law by President Franklin D. Roosevelt in the June 1933. It was created to restore the confidence in the banking system. It is designed to provide for the safer and more effective use of the asset of the banks to regulate the interbank to control the undue diversion of funds into the speculative operation and for the other purpose. In the wake of the 1929, the stock market crash and the subsequent Great Depression, Congress was concerned that commercial bank operation and the payment system were incurring losses from the volatile equity markets. An important motivation for the act was the desire to restrict of the use of the bank credit for the speculation and direct bank credit into the white glass and other thought to be more productive use, such as industry, commerce, and agriculture. In response to this concern, the main provision of the Banking Act of 1933 effectively separated commercial bank from the investment bank. Senator Glass was the driving force behind this provision. Basically, the commercial bank, which took in the deposits and made loans, were no longer allowed to underwrite or deal in the securities. Meanwhile, the investment banks, which underwrite and debt in the securities, were no longer allowed to have a close connection with the commercial banks, such as overlapping dictatorship or common ownership. Next point, I will tell you about the explanation about the function of the investment banks. Number one is to against with inflation. As we know, inflation is the rise of the cost of goods and services. Over the time, they can eat away at your savings. The Federal Reserve works to keep the rate inflation about 2% a year. With that in mind, their assets should earn at least that much, then or more is better to hold their value. As measured by the Consumer Price Index or CPI, the average inflation is about roughly 3% over the last 10 years. It has average over a little over 2%. When inflation rises, the value of the US dollar of the value when inflation rises, the value of the US dollar may fall. Foreign stock funds can act as the hedge, which means an asset can work to reduce the total of loss, as the money placed in the foreign asset can translate over time into more dollar at home. Number two, to advise the businesses and government on how to meet their financial challenges. Deciding how to raise the capital is a major decision for any company or government. In most cases, they lean on an investment bank, either a large or like a Wall Street firm or a boutique banker for guidance. Taking into account the current investing climate, the bank will recommend the best way to raise a fund. This could entail the selling an ownership stake in the company through the stock offer or borrowing from the public through the bond issue. The investment firm can also help to determine how they price these instruments by utilizing sophisticated financial model. In the case of the stock offering, it is a financial analyst will look at a variety of different factors such as earning potential and strengths of the management team to estimate how much a share of the company is worth. If the client offering bonds, the bank will look at the prevailing interest rate for similarity rates business to figure out how much it will have to compensate borrowers. Investment banks also offer advice in a merger or acquisition scenario. For example, if a business is looking to purchase a competitor, the bank can advise its management team on how much the company is worth and how to structure the deal in a way that's favorable to the buyer. Point number two, research, trading, sale. Sorry. Point number three, research, trading and sales, wealth management, assets management, IPO, and more. Investment bank using method research. If an entity decide to raise a fund through the equity or the debt offering, one or more investment bank will also underwrite the securities. This is mean institution buy a certain number of a share or bonds at a predetermined price and resell them through an exchange. Point number two, trading and sales. Most major firms have a trading department that can execute the stock and bond transaction on the behalf of their client. In the past, some banks have also engaged in the proprietary trading, where they essentially gamble their own money on the securities. However, a recent regulation known as a Volcker Rule has clamped down these activities. Assets management. Like JP Morgan and Goldman Sachs manage an enormous portfolio for pension fund, foundation, and insurance companies through their assets management department. Their expert will help to select the right mix of stock, debt instrument, real estate trust, and other investment vehicle to achieve their client unique goals. Wealth management. Some of banks that perform investment banking function for Fortune 500 business also cater to retail investors. Through the team financial advisors, they will help individuals and family save for retirement and other long-term needs. Securities products. These days, companies often to pool financial assets for mortgages to credit card receivable and sell them off to investors as a fixed income product. An investment bank will recommend opportunity to securitize income stream, assemble the assets, and market them to the institutional investors.
Okay, let's conclude this presentation. Okay, the investment banks have given a good impact to the economy by helping the corporations and government. The future of investment banking industry looks bright. Many more pure merchant banks and advisory firms could convert themselves into full services investment banks that would broaden the market and make the service delivery much more efficient. Okay, investment banks help the broader financial market and the economy by matching sellers and investors. The action of the bank also make financial development more efficient and promote business growth, which in turn helps the economy. Okay, that's all from our group. Thank you.